continuing the concept of lump sum investment annuities, and then we use this concept, apply it to investment projects, long-term assets. Okay, so net present value, this method here, in order to choose from different options, at least the net present value has to be a positive number. Okay, so the decision rule for this method is it has to be at least a positive NPV, and then we consider further which project's NPV is higher than the other. Okay, so what is NPV? Again, the differences between the initial cost you spend on an asset. For example, if you spend $1 million to purchase a certain machine, that's the initial cost. You compare that against all the potential returns and you discount it to its current value. The differences between that present value and the initial cost. This difference is what we considered NPV. Okay, the money that you're spending on the asset, compare it against the expected return, and you all trace it back to its present value. The differences between these two is what we call net present value. So the decision rule for this, again, at least it has to be a positive number, and then you compare between different projects, which one of them gives you the highest NPV. Okay, so let's take a look at the example we went over. Assuming you have these two projects to choose from, one of them gives you an equal return. You expect it gives you an equal return every single year for 5 years. The other project has unequal returns, but also its lifetime is 5 years as well. So if we want to choose from these two, just by looking at these anticipated numbers is not enough. Okay, so if the initial cost for these two projects is the same, we'll be tracing back these numbers to its present value and then compare which one has the highest NPV. Okay, so this one is the concept of annuity. It has the same dollar amount every single year. This one here, you'll be tracing it back to its current value. Think of these as individual lump sum investment.